Hi, my name is Ewan Webster. I'm the president and CEO of Thesis Gold, TAU on the Venture Exchange. And we are an advanced stage exploration project in north central British Columbia. It's a high-grade epithermal gold-silver system in the historic Toodoggone mining district. It's road accessible, 3.5 million ounces currently, with a lot of potential for growth there. We've just gone through a transformative merger with the company to the south of us, Benchmark Metals. And we have a very strategic 6 to 10 month plan ahead of us with some significant milestones, new resource, a new PEA. So very good opportunity for future shareholders to get involved in the story at this point.
Brilliant. That's quite a good introduction, actually. Well done, Ian. Hello, welcome to London. How
Thanks.
are you?
Very good.
And we've not spoken about before, so
No.
I think there's a few things I want to get out of this. I want to understand a little bit about you and your background. So what have you been doing previously?
So originally from Scotland, I'm a geologist by background, technical geologist, first class honours degree from the University of Glasgow, and then had aspirations of becoming a professor and went on to do a PhD
This time yet.
at University of Calgary. Pretty quickly realised that wasn't for me, but had a love for exploration and I had a brief stint teaching in the Yukon at a college there in Whitehorse, and then from there went on to be a kind of consulting geologist for a number of different projects through North and South America, various different deposit types and stages of development before joining the group that I'm currently with. And that was, my main role was actually the chief geologist for Benchmark Metals. And so helped take that from what was probably initially 100,000 ounces through to 3.5 million ounces, but got the opportunity to step away and become the CEO of Thesis Gold, the original Thesis Gold.
Right.
A few years ago now, we acquired the Ranch project, and we've been quickly driving that forward as well. So
Right. But you've come together. Thesis and Benchmark come together. And tell us what the plan was. Why did you think that would be a good idea, and what are you trying to do?
I think really scale is what it comes down to. There's never a perfect time for mergers, but I think this particular merger really made sense. I mean, the two projects are adjacent to one another. We've created a district scale land position. Benchmark's Lawyers project have a fantastic foundation of 3.5 million ounces with a very solid PEA. What the Ranch project brought to that was a little bit earlier stage pre-resource, but all the blue sky potential really, and some high-grade ounces right at surface. So it seems like a very natural fit. And the concept is really take two good projects and make one kind of world-class asset.
Right.
And I think the plan that we have in place over the next year is really going to demonstrate that this collective asset really has the scope together.
So why is it working? So sometimes when you see these stories where one company joins another company and they come together and it just doesn't work. It's like the joke is, two $100 million companies are coming together and to create one $100 million company. It's like, so why does it work? What's this got about going for it?
I mean, I think some of those mergers, M&A in our space, I think is definitely needed. But some of those transactions, in my opinion, you're putting together two projects that don't necessarily gel very well, and you end up in the exact scenario that you're talking about. Whereas these two projects are right next to each other, complement one another very well, and really have the potential to be something very significant.
Right. Okay. And the other thing that happens when you kind of go from one project to two projects is it can be framed as an asset. It can also be a liability because the capital that you need to deploy can be prohibitive in the sense that there better be a plan there, and there better be a sequence to that, and there better be some creative value generated off the back of it. So again, talk us through what you were trying to do there.
Yeah, I think that is critical, honestly. And we've been very strategic about what we are trying to accomplish here post-merger. We've just ramped up our drill program for the summer, fall. We completed about just under 45,000 meters, and that drilling was split between the two projects. Right. On the Lawyers project, it was all deep drilling to build out what will be an underground resource there. They will significantly improve the economics around the project. And then the second part of that was on the Ranch project, basically targeting near surface, high grade mineralization, again, to to really bring higher grade ounces forward in the
But open
production
pits.
profile. Open pit,
Right.
exactly.
Okay.
So the drilling this year was very strategically planned. We accomplished what we were set out to do. That will all feed into what will be a global resource across both projects for the first time. And that right now is slated for early Q2 next year. And I think whatever we put out next year for the global resource, it will be very much a starting point. I think we're going to be able to demonstrate that, hey, we're at this, but there's a clear pathway to many more ounces. And most of those are going to be coming from the Ranch project. Simultaneously, we will also be working on an updated PEA that will pull in, because the original PEA on the Lawyers project was just open pit.
Yeah.
So we're looking at bringing in those higher grade ounces from the underground, plus the high grade ounces from Ranch. And I think you're going to see the metrics around this updated PEA improve materially.
So with I get the kind of underground component and the open pit component. And so how close are we? Are we talking about one operation ultimately, but out of the gate, clearly not? I don't imagine it's going to be that way out of the gate. So how, again, do you go through the economic studies? What are you planning for in terms of that sequencing? Because that's what interests me, because the cash flows in and the financing of that are going to be critical. You want as much of it to be self-financing as possible, but initially clearly not possible. So how do you think about that?
So it's a very good question. And to your previous question about sometimes you put two assets together and you end up spending more money, this is not the case at all, because the concept here would be that we have just a centralized milling facility. Right now is projected to be on the Lawyers project, and I think for the moment we just leave that where it is. But we will just truck the ore from the Ranch project.
Not far.
It's about 24 kilometers. It's basically all downhill, apart from a little uptick at the end to get to the mill site. But those ounces will probably be the first ounces through the mill. And then during year one, we'll be pushing a decline in to get access to those underground ounces on the Lawyers project. And very cost-effective decline. I mean, $3 to $5 million.
Okay.
So there's no spirals, there's no shaft. It's pretty straightforward.
Right.
That production will come online year two, and then the open pits on the Lawyers project will be somewhere down that production schedule. And I don't have those exact details for you yet, but in generalities, that's what it would look like.
Because this guy's what's been quite interesting, and you will have been looking around at the market and sort of seeing companies blowing up their balance sheets or looking at economic studies which come in at 30, 50% higher than the last set, etc. And in terms of when and how much of the capital you deploy in terms of advancing the entire project will be you play by ear, in a sense, right? Because those cheap, quick answers in the open pit is where I guess it's going to the fortunes will be made in terms of cost of capital available to you. But I guess what interests me when a company in a position like that is with the economic studies, you've got to have a lot of flexibility to that, given the market that you're witnessing around you. So does that cost more? Does it take longer? Was it just a case of optionality within the same economic study?
You mean for?
I mean, you're going to go through. Okay, we're going to do a revised PEA, and then presumably a PFS, and then presumably, I know it can be simple, but presumably some kind of bankable feasibility. So
sure.
So you've got a bit of time there.
Yeah.
And I'm just so conscious looking around the marketplace as an ex-banker, the cost of capital is going nuts. The options are available are few and far between at the moment. And maybe that changes. But in terms of planning the best sequence of events in terms of how you build this thing out, you've got to be mindful of that, cost of capital, etc. So the optionality you're going to need in those economic studies is going to be greater, so therefore more work, presumably. And that's what I was asking. Does that slow things down for you, or is it happen concurrently?
I think, we do play it by ear. I think that's the simple answer to this. I mean, from our strategic plan that we have in place at the moment is get to the resource next year, early Q2, get to the PEA early Q3, and then we can reassess when we get to that point what the market looks like. In the interim, all of the baseline work is still kind of ongoing. At Lawyers, it's actually complete. At Ranch, it will be mostly complete by Christmas time next year. So that aspect of things is moving ahead, which gives us the flexibility to then, if we want to move to pre-feas quickly or feasibility, then we have that opportunity to do that and the EIA process. But I don't. I think I can't commit to that just now until, like you said, until we see what the general market look like and what those economics around the project specifically look like. Then we'll be in a much better, more informed position to make those decisions.
Right. If the data changes, you can change your mind. Right?
Exactly.
And where are we with cash at the moment in terms of being able to do the things you need to do between now and the new PEA and the revised resource?
So quite a lot of accruals and stuff coming in for the drill program that we've just finished up. So maybe the simplest way to explain it is going into 2024, we'll have about 9 million, mostly hard dollars in the treasury, and that will fund us right through the resource and the PEA. So we'll be able to achieve all of those milestones with the current capital that we have.
And do you need to do any more drilling? Do you want to do any more drilling? Will you be getting some flow through coming through?
So that kind of plays into your question about how
we'll see.
Because we do, I mean, if we're going to go to pre-fees and feasibility study, then honestly, I mean, the resource that we put out next year will be very robust. I mean, most of it's going to be M&I. But obviously to get a feasibility level, some of that will have to be upgraded and most of it would be on the ranch project. But that's also where a lot of the blue sky potential is. So, you know, I'd like to continue to demonstrate the growth potential on that project.
Have you been able, obviously since the coming together of the two companies, I'm so interested in the kind of the corporate structure here in terms of the shareholder register and whether or not you kind of feel you've rotated those shareholders who will leave. Are they rotated out of this thing, or have you attracted a new type of shareholder? And what's that profile look like?
So, I mean, there was a bit of shareholder overlap between the two companies originally, given that they were
same part of the world.
Exactly. So, I mean, that was kind of logical. And we've seen some funds and, you know, cycle through the story now. And we've brought some new investors in, and really, you know, getting out now and telling the story and marketing, and because I think a lot of people were familiar with either Benchmark or Thesis, or maybe both, but don't really quite yet, you know, understand what the potential here is by having these assets combined and getting out, doing interviews with, going right now. We're in London.
Well, explain that. Now's a great time to talk about it. So let's talk about the sum of the parts, right? So 1 and 1 equals 3. So the 1 and 1 equals 3 because of what savings or what upside to this? Just in simple terms.
In terms of savings? Yeah, I mean, savings, I mean, we've projected that between, by combining the projects over the next 2 years, we'll save about $40 million. And that's not coming from G&A or anything. That is purely coming from single geoscience programs, engineering, baseline work, a single permit and pathway consultation process. There's considerable savings to be had there.
That's a nice lump sum, and there will be G&A savings. You don't need to employ 2 of everything.
Sure,
which is great. But in terms of what else about the upside, the scale? So the cost savings is one thing.
Yeah,
but the scale of the opportunity and the speed to which you can deliver that, what's that look like? Do you feel in terms of having 2 separate entities versus 1?
I mean, that's exactly it. That's all the upside. I mean, we would the 2 independent companies on individual paths moving forward, independent resources, but by putting them together, you know, the potential there is for just a much larger entity, and bringing them both together allows us to streamline permit and pathway and all of that good stuff. Because you can imagine, nobody wants to permit 2 projects adjacent to one another either, and the government's not going to go for that. So this allows us to accelerate that, the baseline work, basically.
Okay, so the potential scale, or the theory or the thought of this scale what gives you better access to capital, access to different type of capital, different cost of capital?
I think that's exactly it.
That's the idea?
All of the above, yeah.
Right, okay, and how are you finding it? So again, early days.
Sure.
I get it. We're going to reassess as we go along.
Yeah.
But in terms of this sort of conversations, you're here in London. You're talking to people, talking to investors, shareholders, and you've been trotting around Europe as well. So the general mood is a bit risk off at the moment.
Sure.
But they are still capable of saying, look, when the market comes back, here's what we're looking for. Here's what we need. Have you got some of the things that they're saying that they're looking for?
Indeed. I mean, I think the story now is very well received. You know, I think we're going to be able to have it a significant resource here that people want to see, like the type of scale that you want to see that is going to attract large corporates.
What's the PA? Remind me of the PA numbers. I mean, I know it's the all PA, but broadly, the starting point is what?
So 12-year life of mine at about 1.5 grams head grade gold equivalent.
Right.
After tax NPV of 589 million Canadian and after tax IRR of 24% with a 2.8-year payback. Those numbers are going to improve materially by bringing these two projects together.
Okay, and the new PA will be ready when?
August next year.
Right, okay. So we've got about 9-10 months to wait for that, but materially improve because of the two coming together, which you've organised.
Yeah.
Okay, so obviously gold market has been... Well, gold's fine.
Gold's fine.
Gold equities.
But there's a complete disconnect between gold.
Yeah. So what gives? I mean, something's got to give. I think there's going to be, you said earlier, a bunch more M&A needed, or maybe some of these companies need to go back into the back of the drawer somewhere. That's good for you guys, right? It's good for funders because they're not sort of deploying capital, and shareholders not deploying capital on crappy little projects. And where you are, you're surrounded by some big names there. I mean, you're in the right part of the world as well, aren't you?
We're in a great part of the world. I mean, where we are, and that kind of north central British Columbia, there's been about $5 billion worth of M&A in the last 5 years alone. You just saw the Newmont deal go through. I think Newmont's keeping all of those BC assets. Part of the reason I really like the Toodoggone where we are, so in terms of, I mean, I'm a geologist, I'm getting into geology, but we're in this Stikine terrain, and we're on the eastern side of the Stikine terrain, and everybody's familiar with...
There's this horseshoe type.
Yeah, exactly. Yeah, and I kind of came up with that as a bit of a marketing tool, because everybody's familiar with the Golden Triangle.
Yeah.
But, and there's been billions and millions of dollars spent out here exploring, but in the Toodoggone, which is the same rock, same age of mineralization, same style of mineralization, it's seen a fraction of those exploration dollars. But now that we're spending money there, we're exploring and have been for the last kind of 5 years, I think we've been able to demonstrate that, hey, there are large deposits here. And in terms of the camp, the jurisdiction, the infrastructure, I mean, we tick all the boxes to make this, tier 1 jurisdiction that would be very attractive.
Right. Okay. Well, stand out here so far. I hope you stand out here next year. Appreciate you coming on, sharing story.
Pleasure. Thank you.
Appreciate it.